So we're the Bates International Group. We're not going to waste a second because we're super excited that we've got Bill Milko with us. There's people who are filing in, so I'm going to go ahead and Bill, can you introduce yourself for everyone and just jump right in?
Sure, everyone. So hi, my name's Bill Milko. I work over at the DC Housing Finance Agency. I've been there for a little over 7 years. Before that, I was at the Maryland mortgage program. So I'm pretty well versed in Maryland and DC home buying. And DC by far has the most money available to anybody buying a home. I always like to tell people you're not really trying to buy a home as much as what you're really trying to do is to borrow a couple $100,000 from a bank. And they don't want to lend you that kind of money unless they know what your credit looks like. They don't want to lend you that kind of money unless they know what your debts look like compared to your income. And they're not going to lend you that kind of money unless you're going to put some money down into the deal. So I tell everybody your credit, your income, your debts, your debt to income ratio, your credit score, how long you've been buying and student loans, car payments, big payment items or small, that's all on the borrower. There's nothing anybody else can do about any of those factors except the borrower. So if you do have sufficient credit and decent income, the only thing you're missing in order to purchase a home is the down payment. A lot of people are under the misconception that they need 20% of the sale price to put down. In reality, if your credit's good and your debt to income is good, you only need 3% or 3.5% of the sale price. And so Open Doors will offer you that money in down payment on our program, but everyone's also aware that HPAP offers 6 different loan amounts. They don't give any kind of a percentage like we do at Open Doors. We provide the minimum required to get you into a home. HPAP gives out 6 different loan amounts ranging from $70,000 to 202, but technically 202,000. Technically, that's $74,000 to 206,000 because they're also going to give you another $4,000 to use for closing costs. First question I always get is, can I combine these down payment programs? And the answer is yes. The only thing I would say is they all have different requirements. DC Open Door says here's 3% of the sale price, and we don't care what you do with the money. You can use it for down payment, or you can use it for closing costs. HPAP says here's your down payment money, and here's closing cost money. You cannot mix those up. So they do have different requirements, but as long as you're meeting those requirements, you can absolutely combine those programs. So Dr. Ben Carson, when he was at our agency, mentioned the fact that the average net worth of a homeowner is around $200,000, whereas the average net worth of a renter is closer to $5,000. So the sooner you can get into a home, the better off it is. So if you've worked to get your credit to where it is, you have income. And again, the amount of money you're getting from HPAP, some people are under the misconception they need to be making a lot of money. I was actually shocked watching the news this morning, asking people in the DMV, what's the lower middle income wage of a household size in this area? And everybody on the street was saying 100, 125. One guy said 200,000. And the actual answer they said was $75,000 a year. Now that's, they say, is in the lower middle class of the DMV. The HPAP program, to give you an idea, if you make, I think, less than, and Ebony might correct me on this, I think it's less than $43,000 or $45,000, and you're a household of one, you qualify for the maximum of HPAP, which is $202,000 in down payment money. And obviously, if you're buying a house with a sale price of $400,000, which would normally be out of your reach, you're putting down 50% of that sale price just through your HPAP money alone. And
Mohammed, I know you've got it on the screen.
You know,
and I didn't even get it. I jumped right in and didn't even introduce the team. But Mohammed, go ahead and introduce yourself and share that screen. I know you got it.
I do.
Okay.
So give me 1 second. I'll pull up the table for you guys.
It's 49.5. It's 49.5.
Okay, thank you. Because I know I'm always like, I should really check that table.
If it's less than 49.5, it's 202 whopping $1,000. Let's see it.
49.8.
So and when you're looking,
I don't want the smoke. I don't want the smoke. Okay, I stand corrected.
So a couple things I would say looking at this chart. One, household size going across the top, the incomes they give you from the program on the left side, and then the salaries, or I should say income in the middle. Now, you'll notice like for a household of one, 63,850 gets them 161, but 68,450 gets them 141. And that's only a $5,000 difference between those. So the lender, like Ebony, has to be pretty accurate when they're looking at this, because the thing is, the lender will not count certain income that the HPAP people are going to count. And the most common example is gig economy money. You're driving Uber, doing DoorDash, you start working overtime, or you start a second job that you haven't been doing for 2 years. Most likely the lender will not count any of that income as your household, as your income, but they're looking at your income for the affordability of the house, whereas HPAP looks at your income for eligibility. So they're very generous looking at your income. But yes, if you make less than 49,800, you're going to get 202 in down payment for closing to use towards the purchase of a house. Now, the only thing you got to watch is why you want to make sure you're using a lender who knows how to organize this. You want to make sure your team, your realtor, and your lender are aware that you may be somebody who makes $48,000 a year and you have no debt whatsoever, and you may qualify to buy a, say, $500,000 home, but you're a lot more comfortable in the 3 to 4. And this great team that you have, these realtors find you an amazing bargain at $300,000. They're not likely, when I say they, I mean HPAP, likely to give you a $100,000 first mortgage, which you're paying your mortgage payment on, and a $202,000 second mortgage. Now, they will allow that HPAP mortgage to be higher than the first mortgage, but the lender has to make sure that the first mortgage is at least 28% of the borrower's income. And so then they also have to make sure, the total mortgage is within the debt to income ratios as well. So it's just important you work with a team, a lender, and a realtor that know what they're doing, because these loans do have to be structured correctly. And unfortunately, there's a lot of people applying, and it's a slower process. So you want to make sure you don't add any extra delays by someone who's not really sure how the program works. So I tend to go off like Grandpa Simpson, yelling at us sometimes. So, but like I keep telling people, if you have the credit and you have the income, if your the credit score for Open Doors is 640. It's not just the score, you have to have a history. But if you've been working on your credit, and again, your debts and your income are your debts and your income. But a lot of people I talk to, I'm still surprised, as long as I've been in the mortgage business, that say, I can't buy a house because you need 20% of the sale price. You don't. The minimum you need is 3%. And if you're looking at this, those numbers on the left is the amount of money you have in down payment assistance. That's why they call these programs DPA. So $70,000, even if you're someone who's making around $105,000 a year, certainly most likely represents at least a 3% down payment, which is all you really are required in this day and age to get into a home.
So Bill, can you talk about the actual program itself and when it begins to some of the details? So this is a loan program that converts into a grant at a certain.
Okay, I'm glad you said that. It's not a grant. We like your borrowers, we like you guys. We don't love you. You have to pay this money back. Now there is grant money in the HPAP program, and it's through the EHAP program, EAHP, and that's employee assisted home purchase if you're a DC government employee, and you are then also considered a first responder. So they do have some grant money available. Essentially, it goes away once you buy the home, or you might have to live in that home for 5 years for EHAP for that money to go away. So what HPAP does is they say if you get these top 4 amounts, the 202, 161, 141, and 101, you simply pay that money back when you sell, refi, or in 30 years, or hit the lottery. If you do get the bottom 2 amounts, the 80 and the 70, which would technically be 84,800, and then 74,000, they're going to make that borrower start paying that money back in year 6. However, they'll amortize it over 40 years, and there's going to be no interest that accrues, obviously. So if you're paying back 74,000, that works out to like $151 a month. I forget now. A month for 40 years. But you do have to pay that money back as the open door money too. The 3 or 3.5% from open doors. We like your borrowers. We don't love your borrowers either. So they have to pay that money back.
Bill, let me jump in not with a question, but just logistical thing. The sound, I don't know about for anybody else, Mohammed, but the microphone, it sounds slightly muffled. Is it coming through like that for anybody else?
I'm pretty good.
Okay, all right, no problem. Okay, all right, well,
I'll try to get closer.
Says it's just sounding a little far away. Okay, that sounds good. Go ahead and continue.
A couple other things to note on HPAP, though. The borrower has to contribute money into the deal. The rule is the borrower must contribute the greater of either $500 or 50% of any liquid assets over $3,000. I know that sounds like a long formula, but it's kind of easy. Now, when we say liquid assets, we're not talking retirement. We're talking checking, savings, stocks, bonds, any liquid accounts. So if somebody has $7,000 in the bank, they would be $4,000 over the $3,000 limit, which means they would have to contribute half of that $4,000 into the deal. That means the borrower would have to bring essentially $2,000 to the table. Now, if the borrower paid for an appraisal, a home inspection, an EMD, all that is considered part of the being money brought to the table. But it's important that if you're on an account with your mom or your dad, that's your account. And mom and dad might be a little unhappy when they realize that, they put you on their account just, for emergency purposes, but they're going to ask you for all your liquid assets because they are going to make the borrower contribute. Again, the formula is they must put in at least $500 or 50% of any liquid assets over $3,000, whichever of those two numbers is higher. Home inspection. You do have to get a home inspection. They're only going to look at the HPAP people are only underwriters only going to be concerned about health and safety issues. The inspector just has to have a valid Maryland or Virginia license in order to do the inspection. No such thing as an HPAP inspector list or a HUD approved list or anything like that. Anything else? Any other questions on HPAP? Well, at the top of my head, I'm thinking of. Go ahead. I thought of something, but.
Could you talk a little bit more about, the gig work and, when that is, how that's effective, or how people who have that kind of work are effective? And the other question that I had, these are questions from, the audience, were what is considered a resident?
As long as you've lived in DC for 1 year, you have to have a lease, live with parents. Your pay stubs reflect the DC address. Your bank statements reflect the DC address. that type of thing. And what was your first question again?
So someone who does gig work,
Oh, right,
how
right,
is
right.
that money counted or not counted? Can
So,
you talk a little bit more about that or review that?
Yeah, the example I use is my daughter, who's not in the market to buy a DC home. Excuse me, but she's a Prince George County teacher, and I'm gonna guess she's probably. I think she makes more than 79, but I think she makes less than 97. So if she was applying and was a DC resident in that household of one, they would say, well, you make you make $95,000 a year salary, no overtime. You're a teacher. There's no commission.
Is this as a contractor?
No, I'm saying I'm just using it as an example.
Okay.
So if you're that person who makes like say $95,000 a year as salaried employee with absolutely no commission, no overtime, there's no money, and I don't get a bonus. I get $95,000 a year. But going back to my daughter, who she sells earrings online on a part-time basis or at what do you call them, craft stores. And when she sells them, she has a Venmo account that's tied to her bank. So that money goes right into her bank account when her PayPal people, pay her whenever she sells online or whatever. So if my daughter walked into Ebony's office and said, I want to buy a home, I guarantee, or any lender, because the HPAP doesn't care, which is why it's important. You want to use a lender who does know this program. That lender is going to say, you make 95,000. Okay, good. You're going to get this much. But when that file comes to HPAP, they're going to count that $5,000 or $6,000 a year that, we're using my daughter's example, makes, even though the lender's underwriter will not, because the lender's underwriter, when it comes to part-time work in gig economy, they're going to say, have they been doing that for 2 years? Has the borrower been doing that work for 2 years? If not, I don't care what they make. I'm not going to count it for how much house they can afford. But if you start doing DoorDash, after 1 month of doing DoorDash, HPAP will take what you made in that 1 month and multiply it by 12 and add that to your household income. And like I always like to point out, you can see between some of these incomes, it's really less than $5,000. The way this works, though, is a borrower has to apply for this program by contacting a community-based organization and saying, I want to apply for HPAP. It'll take them 1 month to get what's called a notice of eligibility. And that NOE will say, hey, based on your household size of 1 and your household income, now they're hopefully going to catch all that gig economy. They're going to say in your household income of 98,000, you're eligible for 70,000 and another 4. That NOE is good for 1 year, meaning you must make an offer and have it accepted within that year. You don't have to go to closing. You just have to have the offer accepted. So let's think this through. You get your notice of eligibility on March 1st. It says you're eligible for 70,000 plus 4 because you make $98,000. But if you go out and start doing DoorDash and start looking for homes, I'm going to tell you, and I know Ebony's not going to let you do this, but when you make an offer on a house and that loan gets submitted, that HPAP underwriter will add that part-time income you've just started to do. And if they say, well, now you're making over 109, so now you're ineligible for HPAP, that will happen because they will always recalculate the borrower's income. I had someone a month ago call and say, I'm looking at this chart and I want to make sure I'm reading it correct. I would get $202,000, and I automatically wanted to say 206, but she said to buy a home because I make less than 49,800. And I said, well, yeah, if you make a household size of 1, she said, yes. And I said, how much do you make a year? I'm just curious. And her answer was, I make $15,000 a year. And I said, you can apply for this program. You will get an NOE that says you're eligible for 202, but how in the world are you going to buy a house in DC when you make $15,000 a year. And her response to me was, I'm working at a nonprofit right now. In about 6 months, I'll be working and making well over 90. I said, okay, you can apply for HPAP today. You'll get an NOE that says you're eligible for 0202. But 6 months from now, if your lender that you pick is dumb enough to think you're still going to get 202 when you're now making 90,000, they will lower that 202 down to the 101 because they're going to say, well, now you're over 79, but less than 97. We don't care that the NOE you got 3 months ago or 6 months ago said you were eligible for 202. You're making too much money for that amount now. So they're always going to recalculate the income.
So,
Bill,
Bill, you just said something interesting. So if she's making 90 as opposed to in less than a 97, they're going to default to the higher assistance amount?
No, I'm saying, okay, if somebody making 90,000 right now, they're making more than 79, but less than 97, they would be getting $101,000 plus another 4.
Okay, so it will default to the higher assistance amount if you fall in between the eligibility requirements.
Yeah, I'm a household of one. I make, I'm sorry. Okay, I'm sorry. No. They would actually get, they're making more than 79. Wait, I'm looking at this chart wrong because the income. Yeah, if your income is below 79, they get 101. If it's below 97, I'm sorry. It's below 97, but above 79, they're getting the 80,800.
Got it. Okay, so that's clear. The other question I had is, how does it work if you're combining programs? So if you're going to combine HPAP, and then you're also going for DC open doors, which is 3% of the cost of the home. So say we have a $500,000 home, 3% of that is $15,000 for DC open doors, and you're making $75,000 a year, so you're eligible for 101. So that'll be essentially $120,000, including the $4,000 for closing costs. But how do those work? How do those programs work together? Because these are secondary lien like loans. So you have your primary from the bank, you have your secondary, like with the DC open doors, serve as a third lien on the property.
Yeah, absolutely right. I was gonna say, when you were saying secondary liens, I was like, we might as well say triple dairy liens, because the HPAP loan would go into second position. It would be a second mortgage, a second lien. A lot of people would say it's a silent second because you're not making a payment on it unless you're paying the bottom 2 in year 6. Open doors if you're going to get, and you're absolutely right. You're getting 74 from HPAP, another 15,000 from open doors, 3% of the 500 sale price. We would slide into third position.
Got it. And for the bottom 2 positions, you start paying those back in year 6. But for the top 4 positions, those essentially will carry for until you sell or refinance.
Yeah, what I like to tell people is, I remember, I know I look like I'm in my 20s. I'm actually in my 60s, but when I was a kid, and people would have deed burning parties. Hey, been in my home for 30 years. And I like to say, okay, if you get $206,000 from HPAP and you make your payment and mortgage payment 30 years from now, and you're happy you own your house free and clear, not so fast. DHCD, because if you scroll to the top, you'll see it. Department of Housing and Community Development. It's not us. They're going to say, hey, not so fast. You owe us our money. So I'm sure they have some kind of system that if they do have somebody that they've had this, well, they just raised this to 202. It used to be 50 and 80, but I'm sure if they have somebody who got like 50,000 25 years ago, there's some system that says, hey, this person, better notify them in 5 years. We want our 50 grand back. But yeah, you owe the money back in 30 years, or if you had, before that.
Got it. So the first 4 are long-term interest-free loans that don't get repaid until you either refinance or sell a property. And the bottom 2 are midterm interest-free loans that don't begin repayment until year 6.
Yeah, essentially, it's like the top four they want paid back in a lump sum. Although, like I said, I'm sure, if I ever get enough time, I might ask the HCD. I'm like, in 30 years, would someone just say, "Look, I owe this 202." I don't feel like selling my house to get that out. So can I start paying that back? I assume again, I don't know if they would charge interest, but yeah, they're the 101 to 202 get, and as a lender, the lender doesn't have to account for any kind of repayment when they're running the borrower through, to get them approved. In other words, they don't have to say, hey, they're only going to be getting 74,000 because my borrower makes 95 a year or 98,000 a year, 100,000 a year. And they're going to have to start paying that back, but you don't have to account for that as part of the borrower's debt to income when you're trying to get them approved.
And with the DC Open Doors money, how does that work if you're stacking up? So if I'm remembering correctly, that will convert to a grant after what, 5 years, or is
Well, you want to give away our money,
well?
don't you? Well, the DC Open Doors loan used to be forgivable. You're correct in that. It used to be forgivable over 5 years. I want to say in 18 or so, we switched it. And the reason we switched it is it essentially enabled us to lower our rates by about 0.5%. Because when a lender uses our open door down payment money, that means they're using our open door rate. Now, we offer one rate every day for all lenders. But again, the way we make, if we're going to lend someone 3% of the sale price, $15,000, and tell them you don't have to pay this back for 30 years. And when you do, you don't even have to include any interest. We're not making money on that loan. I think everybody can agree. The way we make the money on the open door program and essentially fund the program is the rate on our loans with down payment are going to be a little slightly higher than the market rate that Ebony or anybody, a lender could probably get you. But that's, what I say is the
trade-off.
There you go. Thank you. So yeah, you might pay 0.25% higher in an interest rate because now you're getting 3% of the sale price from us. But the one thing I always say, especially if someone's a first-time home buyer, to me, the worst thing you can do is start running around trying to get an 1/8 or 0.25% better from somewhere else. The whole while you're just delaying getting into the home. The rates have been a lot closer to where they are now over the last 40 and 50 years than they were 2 and 3 years ago. And every time when someone says to me, the rates were a lot lower 2 or 3 years ago, why didn't you buy 2 or 3 years ago? The rates are what they are. So to me, don't worry about it. Work with a team that's going to get you the best deal, best rate, and just go with it. So, but our rate for the open, just to get back everything, the open door rate would be slightly higher. And that's how we produce our money to fund our program.
Gotcha. So, Bill, 2 questions for you because we work with folks that, from all walks of life, different qualifications. One, do you know what the current rate is for DC Open Doors and HPAP? And 2, can you couple HPAP with DC Open Doors with a VA loan?
I can tell you our rates because I had an issue with the rates today. With a VA loan, we don't even offer a VA loan. And I always say the reason is because it's such a good loan, we don't even offer it. You don't need to put any money down and you don't need mortgage insurance. Now, to me, let's say you're a vet and are getting a VA loan and you want to get HPAP because maybe you're a vet making 50,000, whatever. You could certainly combine the HPAP loan because what you would essentially be doing with the HPAP then is just lowering the amount.
Reducing the cost of the house.
Correct. I always like to joke and say the 2 best loans out there are a VA loan and then the next best is a USDA loan. But the house has to be in a rural area. And if you're unfamiliar with DC, let me be the first to tell you there's rural areas in DC. Now, okay, today we actually have last couple of days have not been able to even put out a rate with down payment for an FHA loan just because of the volatility of the market. But today, and for our rates right now, we're still, it makes a difference if the borrower makes more than 102,000 a year or less, excuse me, 80% of the area median income, but that might be as much as 107. Ebony would have a better. But if somebody wants a conventional loan with down payment and they make under the area median income, 80% of it, which our rate today was 7.125. So now the other thing Open Doors offers in addition to down payment is on conventional loans. If you're not putting 20% down, you will have to pay mortgage insurance. And that's not such a bad thing when people, but the more you put down, the cheaper your mortgage insurance is going to be. So if you're putting down 15% rather than 10%, your MI will be lower. And the cheapest mortgage insurance anybody can get is through the DC Open Doors program, which is why we see a lot of HPAP borrowers who say, look, I'm getting enough in down payment. I don't need, it's not 20%, but it's enough. It's a 10, 15, % down payment. Our conventional rate with no down payment today was 6.375. So I would say to a lender, you can use our rate of 6.375 with no extra down payment from us, but your mortgage insurance coverage might be only 6 or 12% coverage instead of 25 or 35% coverage. And that can be a significant monthly savings.
And they can couple that. Do you still offer the mortgage credit certificate?
No, you're the second. What is it with you, realtors? I'm sorry. Yeah, we actually, it's not, and I'm not sure that it's going to come back because, we're trying to get lower rates, and I think they want to kind of try to use our bond money for us rather than use it for the MCCs.
Great stuff. Are there any questions in the audience?
I'm actually
yeah, actually, I have a question.
Sure.
Hi. Right now, I have an HPAP client, and we actually have extended the process because we have not received approval from HPAP. We've made the contact, but they just said we're in queue. So what do you recommend if I'm trying to close and HPAP is, or I should say, not as responsive as I need to be?
Yeah, and hopefully it's going to get better because we've been asking for more staff, and really when they raised these in October, we've been inundated. The email address for HPAP, it's all one word, which is Single Family Programs, and programs is with an S, at DCHFA.org. Right now, I will tell you, they are almost 30 calendar days from when a lender submits an HPAP loan until an underwriter looks at it. And again, the only thing I would say is we have some lenders, nobody on this call for sure, but we have some lenders who are uploading stuff on, say, December 1st and telling their borrower and their realtor, no, I sent the file to HPAP on December 1st. And on December 1st, they uploaded some pay stubs, a loan application, but no appraisal, no title work, nothing. That stuff came in a couple of days later. And so our HPAP people they're starting to drop the hammer and saying, until that file is complete, it's not in our queue. So, and again, we're just trying to get more and try to meet expectations. But right now it is almost 30 days, which is almost how long it takes for us to issue an NOE as well. If a counselor uploads a complete file today, that borrower will get their notice of eligibility in about 30 calendar days. But, the other thing is I kind of like to joke that, well, depending on the NOEs especially, because I'll get a lot of borrowers saying they told me my counselor said it was submitted on December 1st. I always say you want to email single family programs, but also email your counselor, CC your counselor. So you can email single family programs, but at the same time, CC the lender, because it is the lender who's the only one they're going to give updates to. But when I say you email everybody and then ask, can you please reply all, then everybody's on the same page. You know, especially like I said, for the NOEs, all of a sudden the counselor, you know, sees an email sent to the borrower saying, we're still waiting on the counselor to upload your mother's social security statement. You know, then the borrower called me and said, I gave it to my counselor 3 days ago. I'm like, okay, well, they haven't sent it over yet. I joke that if the counselors knew how to collect income and asset statements, they'd be loan officers. Well, if they knew how to sell.
Okay. Does that answer your question, Danette?
Yes and no, because all of what he said has been done, and we've spoken to the general manager and the manager, and we are still waiting. And because the process they're saying is because they only have 2 underwriters working on 70 cases. And so I'm just,
Can you give that email one more time, Bill? Go ahead and give
it all one word.
It's
all one word, single family programs with an S at DCHFA.org. I mean, and again, this is DHCD's program, and I don't want to get myself in trouble, but my old boss said we don't have enough people to.
And that's the problem they're telling us.
Mm-hmm.
Yeah.
Well, send that email for sure. And I think at least you're one step closer, you know, at least. And are there any other questions? Sorry, go ahead, Bill.
I was just saying, put pressure on DHCD to get some help over here. I'd love it. Because, you know, it's when I do the history of HPAP, I'm like, okay, it's been around for 50 years. It's DHCD's program. They simply let GWUL, Greater Washington Umberland, you know, we love our acronyms, administer the program until we became a co-administrator. So my answer is always, they are the ultimate, you know, authority, I should say, DHCD. It's their program.
Okay, excellent. Thank you. Okay, well, I assume, you know, I haven't heard any other squawks that, you know, we're at our 30 minutes. I know it's never long enough, but are there any last lingering questions or burning questions? And certainly you can get a hold of us. You know, we're on all the socials. You know, we're also accessible by email, and, you know, we're here next month, obviously, you know, February the 2nd at 6 p.m. So you can always stop back by. But any other questions, last burning questions for Bill in the audience? Well, thank you for joining us. Come back.
Hi, guys.
Yes, Bill, thank you so much. Thank you, Ahmed, for holding down the team.
Bill.
Thank you.
No worries, guys. Appreciate it.